Hey everyone, welcome back to Yuri's Box. In this video, I'm going to talk about the latest FOMC meeting as well as the summary of economic projections. If you like this kind of content, consider leaving a like, and as usual, nothing in this video is financial advice. So I think there are a few things that are worth highlighting in that got released today, and I'll start from the dot plot. So my base case, my expectations for the dot plot was to see a little more hawkish, a hawkish skew to the dot plot compared to what we saw in last December. So I was basically expecting these guys right here, stuck between 3.75% and 3% to drift higher, and that is exactly what we got. Now the reason why I was expecting that is that, as I've made clear in many of my previous videos, the Fed isn't really in the business of acting in a proactive manner. It isn't in the business of predicting what will happen. It is in the business of reacting to something that has happened. And when it comes down to recent news, you've had benign non-farm payroll reports. Now, granted, the numbers that make up the latest non-farm payroll report figures are not really enthusiastic, because if you go and see and scratch under the surface, you see the bulk of jobs being added, a lot of them being part-time jobs, a lot of them are government, healthcare, and education. And usually when you see that kind of a mix and none of the rest, really, it's not good news. It's historically the sign of an unhealthy labor market. But in any case, at the headline level, things still look relatively benign. Again, the famous hard data still is looking okay-ish. On the inflation side of the story, however, you've had a lot of things pop up. So you've had tariff saber rattling, and you've had inflation expectations rise. Like you've seen PMIs pointed at, you've seen ISM, prices paid, University of Michigan consumer inflation expectations, and I'll talk about that a little later. You've generally seen inflation fears pick up, and really that's the only thing they could react to. And so that is why I was expecting a more hawkish tilt for 2025. I was just expecting the Fed to react to the latest piece of news. And the latest piece of news is on the inflation side of the story. Now, one extra thing I'll say about the dot plot is that what is being painted here is different, notably different from what was said at the podium by Jerome Powell. The dot plot is painting a more hawkish picture. What Powell said at the podium was a more balanced view of things. The key word for this press conference was uncertainty. Powell really didn't want to take one side of the argument. It was really, it's true that some of the soft data has softened quite a bit. But on the other hand, you have inflation fears picking up and yada, yada, yada. Again, just to point out that what was said at the podium is different from what is being signaled in the dot plot. And the explanation for that is quite simple, in my opinion. There are really two things at play. Number one, if the Fed were ever to come out and acknowledge weakness, that would just, be a self-fulfilling prophecy at that point. Because if Jerome Powell came out tonight and he said, we've seen the PMI report, we've read it, we think the world is going to collapse, well, then everything, everything will tank immediately. Hence fulfilling the, the prophecy. So that's something that they can't do. Even if things look bad, they kind of have to act confident, act like they know. to quote a famous song, act like you know. Um, and really, the second reason for me is that they're really trying their best to make the best of out of a bad situation, really, because you see tariffs being, for the lack of a better word, transitory, like you've seen in 2019, and Powell hinted at this during the press conference. But you've just come out, you as a Fed, you've just come out of 2022, where you were burned for saying transitory. And at the same time, you don't have enough proof that we are definitely heading for a slowdown, although part of the data is indicating that. But it is lacking for a smoking gun. Okay, the Fed doesn't have a smoking gun to point against and say, we have it. We have to cut rates. They damned if they do and damned if they don't. So really, this is just trying to make the best out of a bad situation, in my opinion. And this is the way they're trying to do it. Act hawkish on paper and act balanced in front of the cameras. So that is the first bit, the dot plot. Second is Powell actually dismissed the University of Michigan survey, really. And, I don't like being on the same page in agreement with a central bank, but, it is what it is. He really was quite, he shrugged really the latest consumer expectations that, got released on the University of Michigan survey. And I agree. I completely agree. And this is something that I've said many times. The reason why I tend to dismiss this kind of survey is simply because you're asking for people's opinion. And people's opinions can be easily skewed by politics. And this is a perfect example of it. As soon as Trump gets elected, you have Democrats expecting Weimar Germany, and Republicans, expecting Emerald City in the land of Oz. I think in general these surveys aren't based in reality. They are based off of politics, really, and a lot of it is noise. And I think that there are much better instruments at our disposal, like, again, I'll forever be a shill of the of the quits rate, but I think it's, again, the best kind of survey, because it really isn't a survey of opinion. It is a survey of actions. And so whenever people are quitting their job, that's telling you all you need to know. Things are good. If people aren't quitting their job, things aren't as good. So again, that was the second thing. You saw Powell really shrug off the University of Michigan survey. The third thing is the reduction of quantitative tightening. So they're going to continue to reduce the balance sheet, but the Treasury runoff is going to decline from 25 billion a month to 5 billion a month. And on the mortgage-backed security side of things, everything is going to stay the same. So we're going to keep on having 35 billion running off each month. And the way you can see that, visualize that really, is just look up total assets. And this is what you'll see. So I think this is starting in June or April, I don't remember, beginning in April. What you're likely to see is, this kind of more flat line, really. So the rate of descent is going to kind of flatten out a bit more. And I think this is just preparing us for the next round of QE. I don't think it's if we get QE, I think it's when we get, when do we get QE? And I think that we'll get QE whenever, the hard data softens significantly. But in any case, just looking at TLT briefly, bonds liked it. Okay, and I don't blame him because this was definitely one of the negative catalysts, potential negative catalysts that bonds had. You know, there are a lot of things that Powell could have said to upset the bond market, but bonds liked it. For the moment, we're back above $91 on TLT. Looking at the 30-year yield chart, we're still at the bull market support band, and we are still, at resistance or support if you're looking at TLT, which is welcome news. I think we're at a similar spot where we were last month at this point, on February 19th, where we had the PMIs coming up and eventually non-farm payroll report. I think that next week on Monday, we'll have a much better picture of the state of the US economy, and I think that will be a good place to reassess things. So to summarize, we got a more hawkish dot plot as I was expecting in my previous video. So we had these dots really drift up. That's what you see right here. Again, just simply because they were reacting to whatever latest news, whatever is making the news. So in this case, tariffs and inflation fears. But in contrast to this, you have a more balanced Powell at the podium, against trying to make the best out of a bad situation for the Fed, in my opinion, because you really don't have a smoking gun to point against and, really to signal more rate cuts. But at the same time, you have history working against you because you're coming out of 2022 really. So, and the last time they tried to act in a preemptive manner, they got burned in September when they started cutting. Consensus right now is that though that 100 basis points of rate cuts was a mistake, I don't believe it's a mistake. I think we are more likely to look back at this time in history and say we should have been cutting. And again, because rate cuts aren't immediate, I think there's this kind of weird mechanic where when it comes down to expectations of movements in monetary policy, interest rate policy, where you have, rate hikes take time. They work with longer variable lags. But rate cuts work immediately. There's no balance. And just like rate hikes take time to be felt, rate cuts take time to be felt. Now, if you drop them down to zero and start QE like we saw in the pandemic, that is definitely a different case, of course. But if you're cutting a little at a time, you need time to feel the effect of those rate cuts or rate hikes. So I'm in the camp that we'll look back and say that we should have been cutting, and that is not a rate policy mistake. And just to close things off, if indeed we get, as I'm expecting, initial jobless claims to drift higher as we move towards the summer, as well as other data get a bit more negative, what I'm expecting is to see the exact opposite on the dot plot. Possibly as soon as June, where I'm expecting to see these dots actually move down, somewhere between 2 3/4 and 3.5. Okay, something like that. Possibly even 3 3/4. So from 2 3/4 to 3 3/4. Possibly between June and September's ACP. Just again, because the Fed, what does the Fed do? It reacts. That's all it does. It doesn't, try to anticipate events. It reacts to events. So I'll leave it at that. If you like this kind of content, consider leaving a like. And I'll see you next time. Bye.